Hello, welcome back, guys. So, I've never hidden it how much I like Meta. It's one of my top holdings and one of the stocks that I really believe in. Now, it has gone down a lot in the past couple of months, 3 months, something of that sort, and then it skyrocketed again. You can kind of see here in the 3 month chart where it was and where it's being now. And if you take it to like 5 years, you can kind of see it had this pretty much insane decline for not much of a reason, frankly. But again, there is the reason that the company has been losing money because of the metaverse, obviously, yeah. But the business is still pretty strong in terms of Meta. And this is why I believe in this company in the long term and for the long term. And I own it at about 156 was my cost basis when I bought it actually about 3 years ago or so. And I'm happy to see that it's going higher. So in this video, we're going to take a little bit of a look and examine what is happening, why is this going higher, and also, is it a buy right now near 200 bucks? Obviously, today it looks like we could be having a 201 price when the market opens again in the pre-market. It's up. We'll say in a couple of hours, I guess. But let's first take a look at what is going on now. Meta and Snap stocks jump as there is a prospect for of a ban in terms of TikTok. And so you will see here that the stocks jump higher because of restrictions on the use of social media rival TikTok, owned by a Chinese company. Again, there's a little bit of a war here um, between the US and China, especially in that front, and others as well. Hopefully, not an actual war, a materialized one, but there is definitely some war in terms of, pretty much trade. Now, the other thing that happened with Meta is the fact that people got laid off. And you will see here that the company has announced 10,000 layoffs over here. And that's obviously pretty significant. That's a lot of people, very many people. And so the reason why the stock goes up in such situations is not because investors are happy to see people losing their jobs. They are because of efficiency, as the article points out here. Because when you are pretty much laying off people, you're sort of like cutting the slack. So you're going to cut those people that were not that required and they were sort of like a surplus, which the companies do, and it makes a ton of sense. When you have a ton of money, when you are making a ton of money, you want to use your sort of like economies of scale by increasing the amounts of people that you are utilizing. But the problem is if you are not utilizing them properly and if you're not making enough money per person that you are employing, it becomes a little bit of a waste. And so investors like to see it when companies like Meta, for instance, in this case, or many others, especially tech companies, have been laying off people, especially in this climate where the interest rates are sky high. Sort of, they're not that high, but they are getting there, and they keep increasing. So yeah, this is a case where investors love the fact that we're potentially looking at a more efficient business model for Meta in the upcoming years. Now, if you take a look at the metrics tab here for Meta, it's obviously not as cheap as it used to be because at some point it was again less than 100 bucks, so it was like 80 bucks, 88, something of that sort. And back then the P ratio was like 10. Right now it's 22. No, you will see that it was much lower here. But still, 22, 27 doesn't mean that the company is expensive. And again, you have to recognize that it's always, at least in most cases, it's always better to pay a little bit more for companies that are great than actually paying less for companies that are a little bit subpar. So it makes sense to pay more if you are getting a better deal, is the thing. You don't want to overpay, but paying a little bit more is always good than not owning something that is valuable, is the thing. And you will see also that another very good thing for investors here in terms of Meta, the fact that they are buying back shares. And it makes a ton of sense because the company stock price has been going down. It makes a ton of sense for the company to accumulate extra shares because they can utilize these sort of like shares that they are getting back in terms of ways. They are reducing the effective outstanding shares, which means that they can eventually later on potentially even issue more shares in order to pay employees with those, as they are using as they are using shares pretty much to pay as stock compensation to pay employees and give them options and things of that sort. Now, the thing is, the revenue growth of the company, the net income, the free cash flow, they are all increasing. Now, the company had a little bit of a declining growth lately, and we do know about that. That's a known thing for Meta and many other companies as well. But it's not much of a concern because we do know that there is going to be a little bit of a period where things are not going to be that rosy for tech. Now the thing is, do we want and do we actually accumulate now? And this is what we need to be taking a little bit of a look in terms of what the company is generating in terms of profit, and also examine it with our discounted cash flow model, which will tell us more about accumulating cash flows that the company recognizes. Now, you will see that their net income margin is sitting at about 20% right now, and all the other metrics here are pretty solid. The returns on assets, equity, capital employed, all pretty solid. Very little debt here for the company as well, which is nice to see. Now, if we take a look at the financial statements, for instance, the income statements here, and we do have the newer one, you will see that the revenues are slightly less than they used to be. And the net income here is significantly lower than what it used to be, and is the thing that has happened in the previous fiscal year pretty much. So this is something to consider here, the fact that this has been going down. For instance, you can kind of see it in the EBITDA here, or the operating income has been going down a little bit, and also more operating costs and expenses. So this is one of the reasons why the company is looking to pretty much lay off quite a few people here. But the balance sheet of the company, you will see that things are getting also nice here and keep increasing from 125 billion to 126 almost over here. A slight increase, again, understandable based on what the company has been doing. And in terms of the cash flow, which is eventually the most important thing, you will see that the operating cash flow is about 50 billion over here, about 51 actually. 51 billion, and stock-based compensation, take a look at this one. The trend here pretty much keeps increasing. Tons of stock, about 12 billion being paid. And you will see that the free cash flow that the company generated is about 19 billion for the latest fiscal year, is what we're having here, which is a decline from the previous years, again, understandably based on what the company has been doing, and also very understandably because of the capital expenditures, right? I mean, we do know that the company has been spending a ton in terms of capital expenditures, the metaverse, tons of money being spent there. Hopefully this will make a return, and if it doesn't, hopefully the company will abandon this kind of investment in the metaverse, because it doesn't make sense if it doesn't make any returns. Now, what about the valuation? What should we be paying for this company? The company's growth has, generally speaking, been great, apart from last year, yes. But generally speaking, it has been on an average of about, you can kind of see it here, 24%. The tool tells you all the averages and for everything pretty much here at the 5-year. And you will see that it has been 24%. Now, we don't want to go that high because there's uncertainty right now in the markets, overall markets. This is a 5-year projection, so we want to go with something that makes sense, but it's not too high. So we will go with something like 5%, 7%, and 9%, see what we make out of this one. And for the net income margins, we're currently sitting at about 20%. The company usually does more than that. As you'll see, the average is about 30%, so it has dropped recently. So we will go a little bit in between, see how things operate when we do that, what we get out of it. I'm going to go 23, 25, and 28 here. And for the free cash flow margins, again, the company has about 90% for its average, which again makes a ton of sense. So we will go with something like 80, 90, 80, 90, and 100. And for the annual return, let's just go with 13%, what we usually thrive for. About 10% is what you make out of an ETF, like an S&P 500 one, and 13% is what we ask for when we invest in single stocks. It makes a lot of sense. You can ask for more, obviously, using the tool. Any Patreon, actually, who has access to this will have access to this tool. There's a ton of other modules as well, and also this tool that I'm using here. So if you are interested in becoming a Patreon, you can find the link in the description box below this video. But let's hit calculate. And you will see that with these kinds of projections, obviously the first one is very, very conservative, understandably. This is why we're getting such a low price. But these kinds of projections make sense for like 180 almost dollars here and $241 over here, with the current price being at $200. Now remember what I told you earlier, the fact that these are red doesn't mean that the company is not a good investment. On the contrary, I actually think that this is a very good investment, frankly. And again, these metrics here are pretty conservative. I do expect them to be a little bit better for the upcoming years, but this one probably makes more sense, like 7% revenue growth, 25% net income margin. This could be a little bit higher as well, 90% for the free cash flow margin. I think this is the more representative one of the three, frankly. But this is sitting at about $180 with a current price near 200. Again, remember, tons of other things that are very interesting about this company and very important. The fact that the company is a software company, high margins, and margins that are probably going to go higher, probably are going to go back at 30% eventually. It's just advertising pretty much. And the company is still growing nicely, has a ton of money as well in its balance sheet, which helps a ton of assets. That's also very important. And generally speaking, the company over the years is projected to continue doing rather well. It's almost a monopoly in advertising, or I should say an oligopoly in advertising. And they have very nice targeted advertising through Facebook. Is very, very important as well. Now, a lot of people have been scared to invest in Meta, and it made sense as the company's stock price was dropping. But I was always saying that it used to be super cheap, and if you didn't grab it back then, it's still an opportunity, I think. But it's obviously not as cheap as it used to be. However, through the years, I think we will be seeing this company pretty much fly. I do expect the stock price to eventually even surpass 1,000, in which case we will probably have some splits and things of that sort. But I do expect it to continue doing well in the future. It's a fantastic company, pretty much, and I wouldn't be scared about what has been happening. Yeah, the metaverse, there has been a decline in terms of what the company has been making and spending for the most part. This is the most important thing. And this has been a concern. But again, remember that if you take it for the long run, for many years to come, it doesn't really make a difference, frankly, for an investor, for a long-term investor. Thanks for watching, guys. Please leave a like and subscribe, and I'll see you in the next video. Bye-bye.